So, one of the most talked about and very exciting stocks in the market right now is, of course, Snowflake. Ticker symbol is SNOW. And this is a cloud technology company that just recently IPO'd in the past week. And they're actually backed by none other than Warren Buffett. And so, not only is this a relatively young, very high growth tech company that is operating in one of the hottest markets in the world right now in cloud computing. But because they're also backed by Warren Buffett, many feel that it's a little bit of a safer long-term investment than you would otherwise expect for, again, such a relatively young company that isn't even profitable yet. And so that's what we're going to do in today's video. We're going to take a little bit of a different approach. I've seen a lot of reports and videos talking about this stock as an IPO play, like a short-term trading, or maybe even like a swing trading play. But we're going to do things a little different. We'll take a long-term approach at analyzing this stock. So we'll be talking about their business and their finances as well as their future potential, but all within the context of buying this stock at today's prices and at today's kind of valuation and looking at them over the long term. And of course, I'll let you know if I plan on buying this stock myself as a long-term investment. But with that said, we got a lot to cover. This should be a fun one. I hope you guys enjoyed, but let's go ahead and start by taking a look at their IPO, which just happened this past week. And we'll talk a little bit about the company and what they're all about, and then we'll just kind of go from there. Okay, now we'll talk about the company and their business in just a second, but starting with their IPO, because of all the hype surrounding them, including the boost of confidence from Warren Buffett, Snowflake ended up being the largest software IPO in history at over $3 billion. That's more than 3 times the previous leader, as they initially revised their IPO price from $75 a share up to $120, but because demand was so high from Wall Street, they actually ended up opening on the IPO, trading for as much as $245 a share before quickly climbing to over $300 per share. Now, since then, the stock has come down a bit. It currently trades at about $230 at the time of this recording, with every day since then seeing a swing of around 5 to 10% each day. And I think it's safe to say that this volatility will probably continue, hence why so many short-term and swing traders seem to be interested in this stock. But either way, we're talking about a stock that is currently trading for around 2 to 3 times their original goal for IPOing, although it is still actually down close to 30% from their new 52-week high because they had climbed by so much. Now they kind of came back down a little bit, but we'll take a closer look at their valuation in just a second because there's definitely a lot to discuss there. First, though, we should cover why this stock has attracted so many investors, and that's where their business really comes in. Like many other California-based tech companies, Snowflake has a fast-growing cloud business that looks very promising and should set them up for huge profits in the future. See, Snowflake is what we call an SaaS company, meaning software as a service, and of course, you know how high software service margins can be, but what they basically do is they help both small and large businesses manage and analyze their data through the cloud and also do things like build cloud-based applications and even buy or sell data through their marketplace. In other words, Snowflake consolidates the data from their clients and they use it to generate business insights that really helps these companies, and they also help them create applications, which by the way can even run on other huge cloud platforms like Amazon, Google, or even Microsoft. And the end result is that these companies become more streamlined, more efficient, and much more profitable because their business improves. And of course, these companies are going to be willing to pay a lot of money for that to Snowflake because it is so valuable to them. In fact, their data marketplace alone allows these companies to benefit from the data of others as services and solutions get better over time. Like I said before, they can even sell their own data or apps through that marketplace. And that's a really valuable proposition to these companies because the more clients that sign up for Snowflake, the more it benefits the entire pool, and that leads to higher customer retention. In fact, they already have over 3,000 customers, including 7 of the Fortune 10 and 146 of the Fortune 500, with a really high revenue retention rate of over 150%. And you don't have to take my word for it. They, of course, even pointed to this, this really great part of their business model in their S1 filing, where Snowflake stated that the more customers that adopt our platform, the more data can be exchanged with other Snowflake customers, partners, and data providers, therefore enhancing the value of our platform for all users. In fact, their business seems to be so attractive that it not only brought in Warren Buffett to invest in the IPO, although my assumption is really that it was probably one of the younger guys at Berkshire Hathaway that made this play, because Buffett is definitely notorious for avoiding growth tech stocks like Amazon that trade for very high valuations. For example, that was a stock that was actually purchased by someone else. But it also attracted Salesforce, which is a huge and very reputable player in the cloud software market, as they've been the world's largest CRM provider for the past 7 years in a row, which, by the way, stands for Customer Relationship Management. Basically, a platform that helps companies integrate all their different departments like sales, IT, marketing, and so on, and helps them all work together in one place through the cloud. But anyway, having the backing of these type of really big companies is definitely a big deal for Snowflake. It shows a lot of confidence there. So, assuming that the cloud market stays healthy and Snowflake is able to execute, they should be able to not only see explosive growth on the top line, but over time, I think profits will also follow at an extremely high rate as well. And from what we can tell, the market definitely looks like it will remain healthy well into the distant future. According to Statista, the SaaS market has been surging for years and is expected to top over $150 billion this year. So plenty of market share for Snowflake to capture there, which shouldn't be too difficult considering that BMC estimates double-digit 5-year compound annual growth rate for the SaaS market in general of 12% and a little bit more for the entire cloud market as well. So clearly we can see why this would be such a hot stock right now, but what about that valuation? How big of a price are you paying today for what might come in the future, and is that price worth it? Well, to determine that, we are going to have to take a closer look at their financials and their growth potential and compare that to the stock price that you'd have to pay today to see if this is a fair valuation. So that's what we're going to do right now, and I'll just tell you guys right now, this is where the video starts to get a little scary, especially if you're a Snowflake shareholder already. Now, according to Yahoo Finance, they have a market cap north of $60 billion. Now, they're not currently profitable, so instead of looking at profits, we will have to kind of start with sales here. And over the past 12 months, they did about $400 million in revenue. So as a price to sales ratio, that would put them at a PS ratio of around 166. For context, some other big cloud players that are far more diversified, immensely larger, and also extremely profitable companies like Microsoft, Google, and Amazon each trade for just 11, 6, and 5 respectively. That's a gigantic difference. Now, to be fair to Snowflake, the reason they trade for so much more of an expensive price tag is because of the growth potential. Last fiscal year, Snowflake saw revenue growth of almost 175%, while the next closest of this little group here that we just created kind of arbitrarily was Amazon at only 20%. And of course, I say only as if that's a bad thing, but for Amazon to be growing at 20% is really unfreaking believable because they did close to $300 billion in sales over the past year alone, which is pretty mind-blowing. But anyway, the point is that investors feel that the valuation of Snowflake can drop pretty quickly thanks to that really high growth. But even then, even if we were to assume that they keep this extremely high growth rate of 175% throughout the next 5 years and magically their share price somehow still manages to stay at the same current level, their PS ratio still wouldn't even drop to a single digit until 2025, assuming I did the math right there. But that's pretty crazy because we're still assuming that sales keep skyrocketing at gigantic rates every single year, and somehow the stock price doesn't even go up at all. And even then, we still don't really know how profitable they'll be since, as of right now, they're still losing hundreds of millions of dollars a year, with last year being a loss increase of almost 100%. So that's pretty crazy, right? That even in 5 years of gigantic growth and this, flat share price, this is a stock that would still essentially trade at about the same price as some giant behemoths like Amazon or Microsoft or Google, maybe even more expensive than them from a valuation standpoint. And so, thinking about this as like a good long-term investment, look, there's no doubt in my mind that the cloud computing market will only get bigger in the future. I think that more companies are going to turn to the cloud. Their dependence on other companies that will help them manage and analyze their data and streamline their business, I think that'll become more valuable over time. And the demand for that, I think, will go up. And we already know that Snowflake is doing very well. They're operating well. They've got very high growth, at least on the top line. I think profits will follow that eventually because they've got a solid business model. They've definitely, they got the right backing from Berkshire Hathaway and Salesforce. They just IPO'd, raised billions of dollars. Their balance sheet is doing just fine. I don't think funding will ever be a problem for them for investing in future growth in the future. So everything I think is lined up very well for them. I think they've got all the ingredients to be a long-term successful company, but I don't like how all of that translates to the actual stock itself, the actual stock price and the valuation. Because I like to keep things simple. And when I think about if I own this stock and say it dropped like 20, 30, 40% in a week or something like that, I feel like I'd be second guessing my investment in this stock. I feel like I'd be worried about it. I'd be thinking, man, should I have paid such a high price tag for this stock? Maybe I don't feel like I really know everything about them. I probably have to research them a lot and keep up to date with everything they're doing, make sure that everything is going well, just because of that really high price that you pay for it. So it's just kind of crazy to me that you can actually pay less and get a much safer, much larger, more diversified company like, Amazon or Microsoft. And sure, they may not have as explosive growth, but they still give you tons of exposure to the cloud computing market. These are market leaders in these areas. And they offer you so much more on top of that. And I would never be second guessing owning something like Microsoft or Amazon. And if those stocks ever went down, that's a good thing. It gives you an opportunity to buy even more, never have to even worry about it. Those are good, solid, fundamental stocks that you can just hold on to, buy even more if you want. But with something like Snowflake, I feel like I would be kind of second guessing it. I'd be a little stressed out about it. So I like to keep things simple. This does not seem like a stock for me. Honestly, I'd probably need that stock price to be cut like in half because the valuation is just so insanely high. And I know that sounds extreme, but even if you cut the stock price in half, that'd still be like at the same levels as that they were supposed to go for on their IPO. So I don't think it's that crazy for the stock price to go down dramatically. But who knows, maybe this turns into one of those type of very high growth stocks that has just rich valuations, and for some reason the stock price just continues to go up. I don't know, some examples maybe like Shopify or something like that. Some of those stocks that just have always really had high valuations for some reason, and the stocks have just always performed very well. But I just don't really feel like I need to be taking a gamble on something like this. I'd like to see them prove their business more. I'd like to see the valuation come down to more reasonable levels. I think right now there's a lot of hype in it. And at the end of the day, I just think there's better options out there. I'd rather be buying Microsoft or Google at these prices than be kind of gambling on Snowflake and be a little more stressed out and stuff like that. So anyway, not a stock for me. I'm going to pass on this one, but let me know what you guys think. I'd love to hear your thoughts down below. Let me know if you guys own it or if you're thinking about buying it. I'd love to hear your thoughts down there. Thanks again for watching the video. If you enjoyed it, make sure you hit the like button. I've got more videos coming out for you guys this week, so I hope you guys are looking forward to it. I'll see you in the next one. Take care. Bye-bye.